All right, ladies and gentlemen, I hope you had a wonderful day. It was a lot calmer in the markets today compared to yesterday and Friday. But now, tomorrow and Thursday, we are going to be getting a couple of events that can make gold go crazy. So we have a lot to talk about. I want to explain what happened in the market today, some of these weird factors with bonds, rate cut odds, and even the good news, bad news data. It is actually having a big effect. You got a couple of recession fears emerging out of nowhere. We are going to be getting data tomorrow, then Thursday, and then Friday with the non-farms, but it is all culminating into this weird environment. So we're going to go over that, what we're expecting from the plays there, a couple of broader theories. Then I'm going to explain all of my plays today. I actually made a couple, and then I have a couple more plays to be looking at, the questions, and then one of my favorite economic lessons. So Chad, I hope you're ready for all of it. What I need from you, a thumbs up on the video. Make sure you're subscribed. And if you don't know, we are live Monday through Friday, 30 minutes before open, youtube.com/the stock market. We will see you there in the morning. Run it, baby.
Working to the couch, it's the 2020 election. Live in the hills, but I still get a spread. Started with a live, but I still reinvest it. Fear how I feel, then you feel like a blessing. I just want the lesson, I just want protection. I'm up and I'm down, but they sound like progression. Farmer never plans if he waits for perfection. Finger to the down.
All right, off the bat, I think I was getting a little excited with the intro. We have a lot of things to talk about, but the first thing is, bad data was not too good of news today, and we actually had a very weird reaction. Now, before I get into the charts to show you it a little bit, I really want you to understand this. The last couple of days, we were talking about it yesterday, you've been watching bond yields go down, which is bullish for the bonds, but some of the more riskier assets you would think would be kind of rate sensitive, they have gone the other way. That's getting people asking, wait, what's going on? The rate cut odds, remember, we weren't pricing in that many after being very aggressive in the beginning of the year. Well, coming into this data, coming into Powell, those odds are starting to creep back up. The question should be why, and the answer is it has been a little bit of this reaction to data. Even though equities may not have been flowing and moving to show you this story, what is going on is that a lot of the data, it is either showing a weakening economy, or even if it's weakening, it's having higher prices. Yeah, PCE and a couple of things are looking good, but if some of these trends keep going how they have been, it leaves us at a pretty awful place. And now the thing people are starting to get worried about, are they worried about a recession? No, but they are worried that the data is going to start looking like that. There is some people saying, well, maybe the recession started in October, but more so people are worried that a couple more data prints from here, if they don't really get better, it's going to start painting a whole different story, or a more cautionary story than this whole no landing, soft landing, whatever we've been dealing with. So that's what got us here, and that's why I'm saying today, the JOLTS jobs openings, they came in low. They came in at 8.03. It was expected to be about 8.3, but if you guys remember some of the older videos in beginning or end of last year, we were talking about the JOLTS when things would get good. It used to be the JOLTS would miss. We would rock it, and everybody loved it, and we were talking if there was going to be a 7 handle. Well, you got really close to that today, but you had your pop, then you sold off for a decent amount of the day. You went up, but you were negative from here, and then even after all of this, it may look like we did a lot, but you're right below that 5,300 or like right there, and it's just barely higher than it was yesterday, 0.13 on the S&P and 0.17 on the NASDAQ. That's not too big, and then you'll notice, once again, the bonds gapped up today. The data came out. They did the same exact move, but before, while the market was hitting a low, the bonds were getting back up to the high, and then they kept going. This is the weird dynamic, because bad news was not good for equities today. Good news has not been bad for equities, but if you do pay attention, it has been having that effect on the bond market, and that's what we got to watch moving forward. Otherwise, we may be entering into an era, maybe second half or summer, where we start getting data and this good news, bad news, good news reaction. I mean, it's leaving you with a head scratcher. So this is definitely something I would be watching here over the next coming days and weeks. And on top of it, just this data that we had today, it gave us one of those weird responses in that area. And now we got to wait till Friday Thursday till we get the non-farms and then confirm it. But here's the deal. Whether people are worried about recession or not, or the data, just you've seen this before. You get worried right ahead of the event, and then if Powell comes in dovish, everyone's going to take this idea and then throw it away, and then back to euphoria. That's kind of the weird nature of the market, especially over this last year and a half. So that's where we are now. Hopefully you're prepared for everything and you got a little bit of patience. But now, coming into the second key, this is what I'm talking about here with the title about gold. So before I get into that, here's the other part I want you to be attentive of, is that you have had these global elections, Mexico and India, and over the last 48 hours, these countries and these currencies have gone absolutely insane as a result. In literally Mexico, they were like, oh, it's going to be like AMLO. It's AMLO this. AMLO had a stable currency. As a result, the election currency goes crazy. Stocks drop. Then today they're green. The other day you had India. They're like, Modi won by a huge victory. It shows everybody's in agreement. They're going to be able to do so much. India rockets up. And then today they're like, oh, exit polls show the margin wasn't there. And then stock market in India and their currency starts going crazy too. The point I'm saying is that you're coming into an election this year, and if this is how we're getting responses already and you kind of see how sensitive everybody is, yeah, what happens when we get a new U.S. president or the same one, and then people start thinking implications for the U.S. dollar. So that's the big part, and keep that in mind. But now for tomorrow in that event, just one more word to the macro here. Bank of Canada is tomorrow, and this could be another big thing for the broader picture. If they decide to cut rates, how they go about it, how they communicate it, that could start leaving you clues for everybody else. The ECB on Thursday, they're going to be the next day after that, and then even the US and everybody else. But why is this crazy for gold? Because so far this year, gold has gone absolutely insane, and the latest crazy $100, $200 moves, it has all correlated with Bank of Switzerland or Swiss National Bank cutting, the Bank of Brazil, and all of these other little moves that were both surprising or started to make a move towards the cutting that everybody has been anticipating. So this is what I'm looking for tomorrow. All you got to see, do they cut rates or not? And if they do, it's going to start the chorus of everything else, and then I would be looking out for gold. But that is your second key. And the final thing, man, I got to reiterate this because you've already seen it happen. Literally, the bonds over the last couple of days, some of the AI names except for NVIDIA and even China to a degree, watch for the first half trends to confirm or deny. We are fully entering the second half of this year. You're watching even the rate cut odds move around, and that has been the big focus. But the fact of the matter is, as we get into this second half of the year, we need to be asking ourselves, one, are the trends from the beginning going to uphold? And two, if they don't, is it going to be a reversal of those trends, or is it going to be some other industry or anything of that nature? So I think we've seen a lot of this so far. I would definitely keep your eyes out for this, because by the time we even get to the end of June, I think we're going to have some answers, and middle or late June, before you know it, man, earnings season is going to start back up. Yeah, you're going to be in buyback blackout period. I know, it's wild, but that is all I have for you. But now, let us get into the plays. So, right off the bat, I got a couple of plays, and we'll even talk with some of the plays that I made here today. But number one is oil. So I thought I gave a good plan on it yesterday. A couple people asked me. I got worked on it, so I think I'm down $1,300. At one point, only down $500 or $600. Oil has been going crazy, and the reason why I played it, it was down around 5% yesterday, or just under that. It was 5 by the time we made the second average, but it's been 5 days in a row of oil dropping. It's been a big margin. It's given up now 4 or 5 months of gains. Usually these bigger outsized moves, I'm just going for that. Yes, I'm catching the knife and going for the move, and I think it's decent. Last time we traded around these prices, it worked out good right when it got above there. Stop touching it. It falls back down. I am down for it. So I'm just going to be holding these MCLs. I'm playing oil till it goes green. I'm down to average at 72 and 68, but I'm not going to be too strict on it. But essentially, I think it's going to have one of these bigger flushes like it's doing, and then that'll lead to one of these crazy pops, or we we get news that could change it. But oil has found a way to kind of stay around. If it does totally crater, then we could start getting worried about recession. But I don't know. That's fooled many people, including myself, over the last couple of years. So watch out for that, though. That is play number 1. Then play number 2. I don't have a play on this, but they had earnings after the bell. They did good, and literally it's just reminding me of one of these old AI hype movers, aka an old company in the computer space that's like, nah, we're doing AI now, yeah. Kind of like Dell. And they had their earnings. Wall Street's already getting behind it. There's all these articles. So we'll see if they wake up and tie themselves into that AI scenario. If they do, it could be good. I believe they're already around 2 standard deviations right now. So we will watch how this plays in the morning. But that is play number 2. And then finally, gold, baby. I'm telling you, that's even the main thing of this video. I'm excited for Bank of Canada tomorrow, and the fact is you have the follow-up on Thursday. So if gold don't give you that crazy move tomorrow, that means punt till Thursday. But by the ECB, especially leading into the non-farms, if they both do easing, I think gold is going to rocket. If both of them kind of come back and surprise and say, no, we're not ready to cut, not ready to ease, and they get more hawkish, then that could be negative for gold. But depending on what they outline here, if it has to do with pausing, yes, gold loves that. But not only for America, it applies to all these other central banks. So we will see what they end up doing. But those are the main plays. As far as everything else, I think some people were like, ooh, what's going to happen? They saw me do this today. And they're like, ah! And some people are like, clickbait. You're making me what? So I don't know if you're going to like this or not. But I closed out of my CRM for profit. All the other ones here, TAP, UBS, Tilray, Lunar, Save, ICCM, CDTX. Some of these plays are even as old as like a year or two. I just saw them in my portfolio. I think now is the time for me to get rid of a couple of things. I closed all of these ones at a loss. TAP was probably the most recent play out of any of these, but why? Why did I do this today? I'm living out the cash life, man. I've always talked about how it offers a good return right now, and you could kind of chill. And I have cash in all of these names, so I wanted to de-lever a little bit, even though there wasn't really that much leverage per se. But also, I don't know what my next move is going to be, but I want to be ready for it. There's some plays that I think are dead. There's some that I'm still holding on. There is some tax stuff that I could be using even by doing it right now. That's not the main intention, but literally, I want to be ready for the next move. Kind of as I was sharing with you, going through the intel and a couple of other things, I'm like, wait a minute, how did I've kind of absorbed a lot of these plays, but I want to have cash for the move, and if I'm wrong, I'm still not going to lose. So I want to be ready, but I don't know what I'm going to be ready for, but I will be ready. So I'm deciding to close out a couple of things. I may close out a couple of other old plays. We'll see how it is. I'm not I'm not on like some strict timeline. I don't need to, but I want to slowly prepare myself to really be more cash, or at the very least on the trading aspect. Again, different than the long term, I do want to have a lot of cash available for no matter what happens and the market throws our way without having to be tied to anything, especially as we start getting into the second half and end of this year. So hopefully you feel me on this one. If not, I wouldn't try to read too much into it, and I think you'll see this kind of materialize over the next coming weeks, months, years, who knows, and then we will go from there. But that was everything else still in those oil plays. And now for the question of the day, we had a good talk on this, and they said, Josh, well, I don't know if they said Josh, but they said, why aren't short sellers considered market manipulation? So I really think this is a great question, but I answered this on stream today, and sadly, in giving you the answer to this, it may sound like I am defending this practice or what all these talking heads on Bloomberg and CNBC do. And the sad reality is that anybody on Wall Street knows these laws, and they are playing in the gray area. It's not like I'm trying to defend them, but I'm just telling you what they're doing. They are following the law to a T. Most of the time, they are giving disclosures. That's for the people on TV and all of that. But again, they are playing that gray area. But here is that law. It's simple. And you guys should go look up the 1944, 1945 Securities Act. I may just make a video going over all of it. Yes, has it been amended? It was in like the 80s, 90s, and throughout the years. But we're operating still off of that act when it comes to disclosures, investor safety, and a lot of that good stuff. But quite simply, as long as you disclose your activity and intention, you are usually covered from someone saying, oh, you're doing this, you're manipulating, you're trying to do this. But it's like if you're posting your play, your intention, all of that, it's hard to claim that you're being manipulated. And literally most short sellers, if not all of them, they disclose this in their short reports. Go read any short report. You'll get to the bottom. It'll have the disclaimer. It'll say what they're trying to do, how they plan to do it, yibbity bobbity boo. But you should know that a short seller is not doing all of this work, investigating a company, putting their reputation on the line, and doing all of this out of the goodness of their own heart or because they want to see fraud come to justice or whatever it may be. They're doing it because they want to make money, and they usually disclose that. That's like the general nature of a short report that you understand. And with all of this, the talking heads, everything, I don't care if you like it or if you agree or not, because I just want you to learn this and learn this right here, right now, and don't be naive about this market. Everybody on Wall Street talks their book. That is a phrase on Wall Street, the i.e., these guys on TV you're hearing, they're going to talk about it, what they own and this, and like everyone going on TV, making all of this. They want to give you a show. They want you in there. People are going up and like, think about it. Everybody is heavily exposed, and there is an element where you are expected to realize this. So that being said, this is why certain things aren't manipulation, but it is your goal to ask questions, think for yourself, do not be naive. I would have a distrust of everyone. Again, even myself, that's part of the whole, like, don't show my face, all of this. Like, dude, you ask more questions about me than you do on, So, chat. I think you get it, but for real, I want you guys to be stronger, tougher, understand this, and maybe they'll change the laws and do all of that. But point is, man, you see a lot of people on TV and talking about this and that. There is usually something behind it, but sadly, as long as they're disclosing that and making it evidently clear, I mean, the only person on the hook would be you if you decided to go after it knowing all of this stuff. That's why not hiding information and doing other stuff like that has different implications or different things said about it. So hopefully that helps. I know not everybody likes the answer, but hey, more info, more knowledge. But now, Chattadonia, let's get to the lessons, man. We're getting into the good stuff. It is Chapter 4. We're going to talk about some societal approaches to trade, and it discusses, the pressures of the real world and how things in society is shaping policy and action and trying to understand why people may have done what they did at different times and how they will act in the future. And here's a fun fact. I got really hyped on this, man. We are 72 pages into this book. I put a LOL because it don't feel like that, man. So I'm honored to share this all with you. I'm very proud of some of y'all who have been in it. I've even been asking some pop quizzes in here, and I really hope it is educating you and expanding your view on the world and making you a more educated, equipped person. But, like, there's something bigger at hand too, man. Like, look, every single day, the consistency is beautiful, right? And we could go and do the videos and the watch list and the stream, all that stuff, but, like, look at this, just like 1 hour a day, 30 minutes, 40 minutes. Yeah, it may take me longer, but look at every single day before you know, we're going to be done with this book. You're already making progress. So I hope you apply this in so many aspects of your life, man. Little by little, 1 hour a day, you can go and change a lot of things. I mean, again, maybe the Bible, you think that's a big book, man. I'm just saying, we could probably read the whole thing on the watch. No. So yeah, I hope you're with me on that. But now, Chapter 4, a society-centered approach to trade politics. Our focus on the international politics of trade has bracketed an important question. What determines the specific trade objectives that governments pursue when bargaining with the WTO, when negotiating regional trade agreements, or when making unilateral trade policy decisions? We take up this question in this chapter and the next by examining two approaches to trade politics rooted in domestic politics. This chapter examines a society-centered approach to trade politics. A society-centered approach argues argues that a government's trade policy objectives are shaped by politicians' responses to interest group demands. This approach suggests that the Trump administration's determination to renegotiate NAFTA and other free trade agreements is a response to specific demands made by important domestic economic groups of workers and firms. Similarly, a society-centered approach argues that the British decision to leave the European Union, Brexit, reflects the economic interest of workers as voters who have been or fear that they will be displaced as a result of most trade or trade between Britain and other European economies. Moreover, most of the domestic opposition to Brexit and to the Trump administration's reevaluation of America's trade deals emerges largely from domestic economic groups that benefit from these trade agreements. So, great intro. Hopefully you're getting it. Again, in opinion, but I'm trying to guide you here a little bit. If you hear this first part, society-centered here, this isn't the only answer. So we're going to cover this answer in depth and go through these questions, but there is multiple answers that this will explain, and I have read you some of this chapter, so thankfully we get to make a little bit more progress. So continuing, to understand the political dynamics of this competition, the society-centered approach emphasizes the interplay between organized interest and political institutions. The approach is based on the recognition that trade has distributional consequences. In North Carolina, for instance, people who had been employed in the textile and apparel industry, traditionally a large employer of low-skilled labor, were hit very hard by trade liberalization. Between 2000 and 2004, 207 textile and apparel factories across the state closed down. About 44,000 people lost their jobs. In contrast, North Carolinians employed in the pharmaceutical industry or in finance have benefited from trade liberalization. The average wage earned by people employed in those industries rose in the first half of this decade, as did the total number of jobs available in these industries. In North Carolina, therefore, some people have gained from trade, whereas others have lost. These distributional consequences generate political competition as winners and losers from trade turn to the political arena to advance and defend their economic interests. The American Textile Manufacturers Institute and the National Council of Textile Organizations, business associations representing textile and apparel firms, pressure American politicians for more stringent controls on textile and apparel imports. They are joined by other business associations representing business harmed by trade liberalization. A protectionist coalition gradually begins to form. The Coalition of Service Industries, a business association that represents American financial service firms and many other service industry firms, pressures the U.S. government to conclude the WTO negotiations aimed at liberalizing world trade and services. As other groups that benefit from the expanded trade join them, a pro-liberalization coalition begins to form. Exactly how this competition unfolds, which groups organize to lobby, what coalitions arise, how politicians respond to interest groups' demands, which group interests are reflected in trade policy, and which groups' interests are not, is shaped by the political institutions within which it takes place. This chapter develops the analytical tools central to a society-centered approach. We focus first on interest group preferences, which group prefers protectionism, which groups prefer liberalization, and why. We use trade theory to develop some systematic expectations about trade policy preferences, and we use collective action theory to understand which group will organize to pursue their interests. We then turn our attention to political institutions, looking at how different institutional frameworks create different kinds of interest representation. We conclude by discussing some of the weaknesses of this approach. So I don't know, I hope you're as excited as I am, but like it's saying, you're going to conclude and explain all of this. Then we talk about the weaknesses, and then we are going to get into alternatives. Do not forget, there's many ways to explain these. There is schools of thought that have lasted for hundreds of years and still remain, and there's still kind of a lot of gray area that works in between it, and literally we are working through the future right now and living it all out. You know what I'm saying? I hope you feel me. So let's keep going. The society-centered model and overview. It is useful to take a step back and gain an overall view of the society-centered approach before we dive into the details of its various components. Figure 4.1 presents this logic of the approach as a process that flows from the bottom up, from individual workers and firms engaged in production to trade policy outcomes. The process originates in the interest of workers and business owners who are engaged in the production of goods and services. As we will see, what one does in the economy, are you a worker or a capital owner? Do you work in the apparel or pharmaceutical industry? Powerfully shapes one's interest over trade policy. Some positions are highly exposed to trade in ways that create an interest in restricting the amount of trade that occurs, while other positions stand to benefit from trade and thus create an interest in encouraging lots of it. We typically characterize these alternative positions and interest in terms of individuals' factor ownership or their sector of employment. As we move up from one step of the pyramid, we see that the underlying individual economic interests have organized into two competing groups: protectionist bloc that advocates for high tariffs and a low tariff bloc that lobbies for tariff cuts. Moving another step up, we see the two blocs enter the political system to press politicians to enact their preferred trade policy. Because the two blocs have opposing interests, one side will win while the other will suffer defeat. Which bloc wins and which goes on often is a consequence of political institutions that influence who gets to lobby whom and what incentives politicians might or might not have to respond to the demands of a particular bloc. The political system makes its choice and either enacts a trade policy directly or establishes a bargaining position that the executive takes to an international forum like the WTO. So we'll continue along. Again, I like you to understand it before going to the image, but this is what it's saying. So again, industry factor ownership, it starts with the workers, and then it leads to organizing the interest, and then it goes to the political demands. But remember, only one person wins, and then that's why it's a pyramid. Somebody be on top. It's like reverse, and then sign up for Forex. What? No? Okay, anyways. But the political process depicted here can also feed back such that higher levels of influence what happens on lower levels. As we saw in Chapter 3, trade policy shapes the domestic economy. A policy of free trade will cause economic specialization that gradually reduces the size and political significance of the protectionist industries and interests. Specialization, or the absence of such, thus has consequences for the relative balance of political power between the protectionist and liberalizing blocs. Political institutions might influence how the underlying agents organize. Some institutions might encourage organizing around a class or factor, while other institutions might encourage organizing around industries or sectors. Of course, the basic overview is merely a model of a far more complex process. We could add considerable detail at each level of the pyramid and eventually approach a full description of the actual policy process. Simplified models such as this one are useful, however, as they provide a useful view of the forest without encouraging us to get caught up looking at all of the trees. Having said that, let's begin to fill in some of these many details, starting with preferences and working our way up the pyramid. So trade policy preferences. Because a society-centered approach argues that trade policy reflects interest group demands, it devotes considerable attention to the source, content, and organization of these demands. So before we continue, I'm going to step in here and think about it. Because a society-centered approach argues that trade policy does this, what is that saying? Not all models argue this same thing. We will get into approaches that view it a different way and saying, well, it's not always about interest groups. You know, this is why you could kind of apply all of these theories throughout all of history, see what people did, and then see where we are even at today. So moving forward. Here we examine two standard models of trade policy preferences, the factor model and the sector model. The two models agree that raising and lowering tariffs redistributes income, and they agree that these income consequences are the source of trade policy preferences. The two models offer distinctive conceptions of how trade's income consequences divide society. We examine both models and then turn our attention to the collective action problem that sharpens or shapes the ability of groups with common interests to organize to lobby the government on behalf of their desired policies. Factor incomes and class conflict. The factor model argues that trade politics are driven by competition between factors of production, that is, by competition between labor and capital, between workers and capitalists. Labor and capital have distinct trade policy preferences because trade's income effects divide society along factor lines. Whenever tariffs are lowered and trade expanded, or tariffs raised and trade restrictive, one factor will experience rising incomes, whereas the other will see its incomes fall. Trade, therefore, places labor and capital in direct competition with each other over the distribution of national income. To fully understand the reason for this competition, we need to look at how trade affects factor incomes. To do so, we're going to make some assumptions. First, we will assume that there are only two countries in the world, the United States and China. Second, we will assume that both countries produce two goods, shirts and computers. Oh, we're back to this again. Third, we will assume that each country uses two factors of production, labor and capital, to produce both goods. Fourth, we will assume that shirt production relies heavily on labor and less heavily on capital, whereas computer production requires a lot of capital and little labor. Finally, we will assume that the United States is endowed with a lot of capital and little labor, whereas China is endowed with a lot of labor and little capital. These assumptions merely restate the standard trade model that we learned in Chapter 3. Yes, I was going to say, it's exactly the same one. If you were here or you listened to the computer shirt model, exact same assumptions. You're not missing anything. These assumptions establish who produces what. First, capital will be relatively cheap and labor will be relatively expensive in the U.S., whereas the opposite will be the case in China. Consequently, the United States will export capital-intensive goods, computers, and will import labor-intensive goods, shirts. China will export labor-intensive goods and import capital-intensive goods, computers. We can now see what happens to factor incomes in the United States and China as they engage in trade. We first look at the United States. When the United States begins to import shirts from China, demand for American-made shirts falls. As demand for American shirts falls, American firm manufacture fewer of them. As shirt production falls, apparel firms liquidate the capital they invested in the shirt factories and they lay off their employees. At the same time, American computer firms are expanding production in response to growing Chinese demand for American computers. As American computer production expands, computer firms demand more capital and labor, and they begin to employ capital and labor released by the shirt industry. There is an imbalance, however, between the amount of labor and capital being released by the shirt industry and the amount being absorbed into the computer industry. The imbalance arises because two industries use labor and capital in different proportions. The labor-intensive shirt industry uses a lot of labor and little capital, and so as it shrinks, it releases a lot of labor and less capital. The capital-intensive computer industry employs lots of capital and less labor, so as it expands, it demands more capital and less labor than the shirt industry is releasing. So I'm going to interject here. Pay attention to imbalances. And this example, like I said, it all connects because how these imbalances work between trade, this will be a central part of your economic learning. And it will be probably one of the most pivotal things as we start to get to those lessons. So keep that in mind and hopefully ask questions now if you're not getting this so that we can make sure you do by the end of it. But continuing, consequently, the price of capital and labor will change. More capital is being demanded than is being released, causing the price of capital to rise. People who own capital, therefore, now earn a higher return than they did prior to trade with China. Less labor is being demanded than is being released, causing the price of labor to fall. Workers, therefore, now earn less than they did prior to trade with China. For the United States, then, trade with China causes the return to capital to rise and wages to fall. The same dynamic is taking place in China, but in the opposite direction. As demand for Chinese computers falls, Chinese firm manufacturers fewer computers. As computer production falls, Chinese computer manufacturers liquidate the capital they've invested in computers and they lay off their employees. Chinese shirt firms are expanding in response to the growing demand in the U.S. and they demand more capital and labor. The Chinese shirt industry thus absorbs capital and labor released from the computer industry. Again, however, there's an imbalance between the factors being released and those that are being demanded. The computer industry uses a lot of capital and little labor, so as it shrinks, it releases a lot of capital and only a little labor, yet the shirt industry employs a lot of labor and relatively little capital. So as it expands, it's demanding more labor and less capital than the computer industry is releasing. Consequently, the relative prices of capital and labor change. More labor is being demanded than is being released, causing the price of labor to rise. Less capital is being demanded than is being released, causing the price of capital to fall. Trade with the United States has caused the wages earned by Chinese workers to rise and the return to Chinese capital to fall. Trade between the United States and China has thus caused changes in the incomes earned by workers and capitalists in both countries. Abundant American capital and abundant Chinese labor both gained from the trade. Scarce American labor and scarce Chinese capital both lost. More generally, therefore, trade raises the income of society's abundant factor and reduces the income of society's scarce factor. You should write that down. If we allow this trade to continue uninterrupted, then over time, factor incomes in the United States and China will equalize. That is, wages for American workers will fall and wages from Chinese workers will rise until the wages in the two countries are the same. The return to capital in the two countries will also equalize. This return to Chinese capital will fall and the return to American capital will rise until the return to capital in two countries is the same. The tendency for trade to cause factor prices to converge is known as factor price equalization. equalization or the Stoppler-Samuelson theorem. Trade policy preferences follow directly from these income effects. Because trade causes the scarce factors' incomes to fall, scarce factors want to minimize trade. Scarce factors thus demand high tariffs in order to keep foreign products out of the home market. Because trade causes the abundant factor incomes to rise, abundant factors want to maximize trade. Abundant factors thus prefer low tariffs in order to capture gains from trade. In the United States and other capital abundant countries, the factor model predicts that owners of capital, the abundant factor, will prefer liberal trade policies, whereas workers, the scarce factor, will prefer protectionist trade policies. This is why workers disagree with BlackRock. Oh my gosh. Okay, that was opinion. Continuing, in developing countries, the factor model predicts that labor will prefer liberal trade policies, whereas owners of capital will prefer protection. That's developing countries. Trade politics are thus driven by conflict between labor and business or capital. Because this competition pits workers against capitalists, the factor model is often called a class-based model for trade politics. The factor model suggests that the debate over trade policy is a conflict over the distribution of national income between American labor and American business. Because trade reduces the income of American workers, these workers and organizations must represent them, have an incentive to oppose further liberalization, and to advocate more protectionist policies. And indeed, American labor unions have been very critical of globalization. The AFL-CIO, a federation of 64 labor unions representing 13 million American workers, has been amongst the most prominent critics of globalization. Although the AFL-CIO does not consider itself protectionist, it has fought consistently to prevent the passage of fast-track authority. It is highly critical of the NAFTA and was opposed to the Trans-Pacific Partnership, TPP. Moreover, a large body of evidence indicates that support for trade liberalization is lowest among that segment of American workforce with the least amount of formal education, so-called low-skilled workers. He's giving you all the sources so you don't cancel him for that. Conversely, because trade raises the return to American capital, American businesses should be strong supporters of globalization, and American businesses have been very supportive of globalization. The Business Roundtable, a business association composed of the chief executives of the largest American corporations, strongly supports globalization. It has been an active lobbyist for fast-track authority. It supports NAFTA, the FTAA, and is strongly supporting China's entry into the WTO. The National Association of Manufacturers, which represents 14,000 American manufacturing firms, also supports the WTO and regional trade arrangements. Trade policy demands from American labor and capital thus reflect the income consequences that the factor model highlights. American trade politics does seem to be shaped by competition over national income between workers and capitalists. We conclude with an important qualification. The emergence of conflict between workers and capitalists is based on the assumption embodied in our simple two-factor model that American labor is homogeneous. All workers are identical. Workers are not homogeneous, however, and at minimum, we need to divide labor into distinct skill categories such as low and high skill and treat each category as a distinct factor of production. A model that allows for different skill categories amongst workers yields different conclusions about trade impact on the incomes of American workers. Trade still reduces the income of low-skilled American workers. High-skilled workers, however, which are an abundant factor in the U.S., would see their incomes rise. So it goes on to sector incomes. I think we broke up the lessons before, and I have actually read you this, so I'll save this for tomorrow, but I think this is a good start. I hope you guys, like I said, understand the whole imbalance and how balances get absorbed or not, but hopefully you're seeing this. It's one, understanding the breakdown. I don't know if you saw what he did here. Is this still up? So again, this whole Stoppler-Samuelson theory, the factor price equalization, it was explaining economics and saying how one person does this, capital goes up, capital goes down. It's explaining difference between developed and emerging markets and how they go. But notice it was explaining the economics, and then it gave a theory and then tied it into lobby and then the WTO and how unions support one side and then the businesses and the round table support another. And even then, think about it. Anytime you've heard unions, round tables, we've watched some of that stuff on stream, ta-da, there's a deeper play at work. So I love all of this. I hope you enjoyed it, Chad. We will have a little bit more, but that is your watch list, ladies and gentlemen. Make sure Hydrate Healthy ready to go. Make sure post your watch list. Make sure we see you there in the morning. I need the armor on. I need the helmet shining. And I hope you realize the witness your life has already left you, baby. Don't forget what happened in time. You know what I'm saying, baby? In the game. But Chatadonia, I love you. Drink that water. Stay hydrated, healthy, all that good stuff. I'll see you in the AM and horn.